Welcome to Monday Mornings with Michelle, the new business podcast. Whether you're kicking off your day or kickstarting your business, Michelle is going to kick your ass into next week with the essential fours: strategy, systems, support, and state of mind. Now, welcome to center stage, Michelle Nedelec.
Hey there, peeps. This is Michelle Nedelec, and I'm super glad that you're here with us today because I have the most amazing guest with me, Keith Uthe. Thank you, Keith, so much for being here today with me.
This is awesome. I look forward to it. I'm excited for it.
Way more fun when somebody's here with me.
That's right. Wow. And you said you might have some surprises for me. So I always love surprises.
Excellent. So do we. Awesome. So give us a 5,000-foot view of who you are and what you do.
Well, so I am a mortgage broker. So I'm an independent mortgage specialist that works with multiple lenders for clients across Canada to help them with financing purchases, refinancing, Smith Maneuver. I am a Smith Maneuver certified professional. So I help people with setting up the Smith Maneuver so they can convert their mortgage from non-tax deductible debt to a tax deductible debt. And I work with many real estate investors who also are looking to build future wealth. So, but for me, any client I work with, it's about helping them to see and understand how their mortgage is part of creating a financial life by design rather than one by accident. And so that's such a critical part of everything I do for me, because my personal vision is everyone is living a life of abundance. And so I want to fulfill that every day.
Nice. I love that. And we will totally get into the Smith Maneuver and a whole ton of other acronyms that mortgage brokers use that nobody else knows what they mean, because that's just fun and entertaining. That's why we're here.
Right. That's right.
So let's give it a little bit of background. How did you get into this?
Boy, well, you know what? It kind of all started, like my whole learning and understanding of the financial industry or the mortgage industry began when my wife and I purchased our first investment property back in 2003, and then progressed doing we did a flip property. Then we started buying our buy and hold properties, and I really enjoyed it and was in a job at that time that was paying me a salary, and that's what I did at that time. And I knew that there was something bigger and something more out there for me. And when I met a coach that I still get coached by to this day, he helped give me the guidance and understanding of what maybe more could look like for me. And so I changed jobs and was with a private lender as a junior underwriter. Downturn in the market happened. Unfortunately, I was let go. And that's when I got introduced to a couple of people that were friends of my coach, actually, and had been in the mortgage industry as brokers for many years. And I connected with both of them. One of them happened to be local here in Calgary. And that's when I made the move. And that was over 5.5 years ago now.
Nice. You say unfortunately, but more often than not, I know that getting fired from jobs has been unfortunate for a lot of people.
Yeah, it was, exactly. And, it was unfortunate because it was a surprise.
Right.
Fortunate in that it has accelerated me to be where I am today. And I wouldn't be who I am and where I am today had that not happened, because it pushed my limits.
Right. So talk to me a bit about who you love to work with. Who's your ideal client?
Oh boy. For me, the ideal client is the one that can qualify for a mortgage. But who can qualify for a mortgage? Well, just about anybody can qualify for a mortgage if they have an open mind as to what that might look like for them. I work with A lenders, I work with B lenders, and I work with private lenders. And depending on a person's individual situation, there's one of those three categories that they fit into. With the understanding of what it is. I work with a lot of business for self people. Well, they do things when they file taxes and stuff. And a lot of times they're business for self because they're trying to lower tax implications, which means they declare less income. Well, that also means they fit into a different segment of lending. And so we have to figure out what works for them, because there's a balance between how much tax you pay and what you have to pay for an interest rate. One's tax deductible, one's not. So, those are things we talk about in business for self people. Then there's first-time home buyers, and understanding and helping and working with first-time home buyers. And sometimes those first-time home buyers they're buying with, this is our first property, but we want to build an investment portfolio. So, I work with a lot of real estate investors from, their grassroots buying their first property to those that have already built a portfolio and are stuck. They're stuck on lending and then trying to figure out how can we continue to buy. So is there a little specific client that works? Well, not always, but because unfortunately not everyone can get a mortgage with our mortgage rules and stuff. Really what the best client is one that's got an open mind and wants to learn what I know and work with me because of what I know and what I'm going to be able to do for them, not as someone who they see as just a button and pencil pusher that just throws it in and sends it off without getting to understand the client. Because it's a long-term mortgage is a long-term commitment, and understanding not just what's happening today, but what's going to happen over the next 3, 5, 10 years for you and your family that could impact what choice and decision you make today. And that's where a lot of people don't know or understand, or other brokers or banks, they don't ask that question and they miss that. And then all of a sudden, that's when they come to me in 3 years and go, my kids decided to go to university, and we kind of knew on the other side of the country, we kind of knew that might happen. And we can work remotely. So we'd like to move, but we just found out we have a $30,000 payout penalty on our mortgage. And we didn't understand the implications of that when we got our mortgage. What can we do?
Right. I was going to say in that whole, I think you only spoke for about 3 minutes, but you dropped about 20 items there. So I'm going to go through all of them from new people, new couples, all excited, getting a brand new very first, or even young kids just getting their very first mortgage, and how that might work out, all the way through to investments and tax implications and rates versus buyouts and investing in Canada and Canadian real estate. So peeps, if you're listening, we're going to cover the whole gamut here, but we're going to start off with the newbies, because I think the foundation needs to be laid for kind of understanding. And I think we can do that if we start talking about the newbies and how they sign up. So what do you think is the most important thing for a young person who's just getting into their very first, say, home or piece of real estate, whatever you prefer? What's the most important thing for them, do you think?
So number one is, what is the plan over the next 5 years? How does this property that they want to buy, whether it be a condo, a townhouse, or a house, how does it fit into the plan over the next 5 years, based on the job they've got or the job they're hoping to get, any of those things that have an impact on their life. I mean, they're young. The chances of maybe getting headhunted to a job somewhere else, deciding to take a pivot in their jobs. I mean, there's any number of things that can happen for a young person that, if thought about ahead of time, the choices and decisions that can be made around who the mortgage lender is and the type of mortgage, those will change things. So we need to have those kinds of conversations with them. And then looking at, first-time home buyer plans. Have they had a chance to even start saving, in an RSP, to draw from an RSP? Are parents or grandparents or siblings looking to give them a gift for down payment towards their first home? Or are parents, grandparents, or siblings willing to co-sign to help them get into that home because they don't have enough credit history, or maybe they've got student loans, so their debt servicing is a little off? So there's different things we have to look at for those first-time home buyers that can come into play to help make this happen, and what and who is willing to maybe participate and help to make it happen for them. Nice.
I wish that my parents had had this conversation with me when I first got out of high school, and had, those goals, dreams, ambitions were all over the map for me. They haven't changed at all. So, but being able to have the conversation of what if somebody was like me and they went to university in Edmonton, they took a year off and moved to Ottawa, and then they came back to Calgary, and then but I knew at that time that real estate was the thing to buy. I just didn't I was going like, I'm all over the place. I don't know if I can afford a mortgage. I had roommates everywhere I went, even though we were in apartments. Like, it totally would have made sense to me to invest in something somewhere and either have, roommates with me, or to buy in Calgary at that time, which was super cheap then, would have been brilliant then. What would you say to somebody like that? That's a really hard question to answer.
Yeah, it is. You know what? And that's where it comes down to, so number one is the consideration of real estate of an investment. Do they see real estate as an investment initially? And that even if they decide to move, it can continue to be this investment piece that now becomes a rental property and has that possibility for them. Now, not every property makes a good rental property. So that's where that understanding.
Talk to me about that. How do you know what does?
Well, so you got to look at how much rent, if you weren't living there, how much rent could you get for it? And what are your carrying costs for it that you have to worry about? Mortgage, taxes, insurance, condo fees, if it's a condo, what property management, if you have to have someone manage it for you because you're no longer in that city, or do you have family that will help you with managing it? Or like, how are you going to, maintenance? How do you account for these things? And what does this property look like if you end up not living in it? Now, that doesn't always mean that it's a no-go, but it's a balancing point of understanding about, could this based on what you're telling me your plan is over the next 5 years, does the property that you're looking to purchase make sense if you're not living there? Because there's nothing worse than buying this property and you're living there and then you get headhunted, or you've got this plan to go to Ottawa or go to France or whatever it is, and you put somebody in there and you now have to feed it $300, $500 a month to make it work. How does that impact now wherever you're going, and how your lifestyle and what you're living, wherever it is you're ending up in for the reason you're there? So that's part of that conversation and consideration is what does that future look like potentially, especially for younger people, for people that maybe are a young family and they have kids and stuff, their chance of moving is maybe less. There's still a conversation to be had, but there's some different parts of it. How old are your kids? What about schooling for your kids? Are you okay with the schools that are in the area where you're wanting to live, as far as being a consideration for you? Or, is there a specific type of school that you want them to go to? So you're thinking that your kids are only 1 and 2, but when they're 5 and 6, you may want to move closer to this school that you want for them. There's all these different considerations that are different based on a person's situation.
I love that. Awesome questions. Thank you. And because I find that people like you have so much knowledge, and the people that have never kind of looked into this industry is like, oh, I just go buy a house and I go and get a mortgage and I'm done, right? It's like, no, there's so many different layers to this and so many different questions that need to be asked and considerations. So I'm loving this. So a lot of people also think that if I go to get a mortgage, the most important thing is the interest rate on it. And in my experience, that has been a disastrous way to look at mortgages. So what are some of the considerations that people need to look at other than just interest rates?
Oh boy. Well, there's multiple terms to a mortgage. So there's the amortization length. Now, if it's a high ratio insured mortgage, first time home buyer, the maximum amortization is 25 years. There's no change in that. It could be lower potentially if they wanted, but maximum 25. If they've
I'm
got,
going to hold you right there. So when you say high insured, what do you mean by that?
high ratio insured means less than 20% down.
Mm-hmm.
And that means it has to be insured, a back end insured by CMHC, Sagen, or Canada Guarantee, which basically those people are guaranteeing the lender on your ability to continue to pay that mortgage. And should you default, they are going to insure the lender against that default. So that's what that means. And so those mortgages are, kind of, that's the typical mortgage that first time home buyers typically get into. Now, there are people that do have 20% down saved up, and then they end up in the conventional mortgage pool, which means 20% down or more. And there's 25 or 30-year amortization options when you're conventional. So that's one set of the terms. The next is fixed rate versus variable rate. Which one fits better for you? What is your risk tolerance? What is your plan over the next 5 years? Because a variable rate has a 3-month interest payout penalty. Fixed rates typically come with some sort of interest rate differential calculation. And so that's where people run into those tens of thousands of dollars in payout penalties, because they've got these fixed rate mortgages because they didn't understand the difference in that. And that's where a person's plan. Now, the fact is 33% of Canadians break a 5-year mortgage term. So because just on that fact alone, your consideration of who the lender is, how they calculate penalties, whether it's fixed or variable, should be a key consideration. Then there's other things like prepayment privileges. How much can you bump up and make an annual lump sum payment on your mortgage, or a monthly increase in the mortgage? Can you do double up payments? Can you do a skip a payment if something comes up and you need to skip a payment on a mortgage, which means you kind of get a free month of where you only pay the interest, you don't pay any principal. There's things such as that. And a couple of the ones that really get people in trouble or get them in the way, one is called a bona fide sale clause. And what that means is, hey, we're going to give you this great interest rate, but you can't refinance within 5 years. You have to keep your mortgage with us at this mortgage rate, because we will not let you refinance. The only way you can pay this mortgage out is if you sell to an independent third party. So that's a bona fide sale clause. Some lenders also have a clause such as a payout penalty that's 3% of the mortgage balance. So they might not do an interest rate differential, but it's 3% of the mortgage balance, which actually in some cases ends up being still significantly less than what the banks charge. But that's certain things. And in some cases it's like, and this is where people, they fight to get the lowest rate. And it's like, well, yeah, I can get you the lowest rate, but here's the implication of that 0.05%. I can draw, yeah, we can go to that 0.05% lower on rate, but here's the implication of that. And that's what people often, they just get so focused on the rate that they forget about that. And they don't look at what is truly the implication of 0.05% on a mortgage rate over the 5-year term of the mortgage. And what the restriction could end up costing them should they actually end up breaking. And there is a 33 to 35% chance that they will break, even though they say, I don't plan to break my mortgage.
Yeah.
Right?
Some people never plan to break, and then months later it's like, well,
Well,
who knew that was going to happen? COVID.
Things happen, so many things can happen. There's so many variety of things that happen. You end up having children and a spouse decides to stay home, and now you're down to one income. Somebody gets injured and can no longer work, and now you're down to one income. Marital breakup, now you're down to one income, and maybe having to pay support payments or rely on support payments, whatever that happens to be. So there's any number of things that pandemic happens and you lose your income, you lose your job. There's any number of things that unfortunately can happen, and it's considering those things that are possibly happening, making decisions so that should those things happen, how can you protect yourself in the best way possible by considering some of these different terms in mortgage. Not all mortgages are portable. That's another consideration. If you're somebody, maybe you're in the military, or you're in the RCMP or something like that, or maybe you're in a medical field or something, and the chances of you relocating or getting moved are high, Well, the consideration of what lender you should have your mortgage with is also another an important part. But also knowing that some people that are in those positions, some of those people have some of the greatest real estate portfolios out there too, because they've done some things strategically, knowing that that can happen to them.
Right. Well, you've already been a plethora of information, and and clearly, if somebody's going in to go and get a mortgage of any kind, I think it's a no-brainer at this point that they got to go and talk to you, because it's just like there's no way anybody could know all this stuff about, oh yeah, I just want to walk in and grab a mortgage. It's like, no, that's a terrible idea.
Yeah, I mean, we don't go to our doctor and say,
I need
hey,
this drug.
yeah, hey, I need this drug. Just sign the paper and give it to me. That's what I know I need, and that's what I want. That's just not the case. Like that's why we have trusted professionals that we rely on. We have our accountants. Most people, or many people, have accountants that do their taxes because they understand that part of their life. We have mechanics that work on our cars. Unless you're a mechanic yourself, you likely don't work on your own car. You don't do anything significant on your own car. You maybe change your oil, maybe you change your filter and fill your washer fluid and put air in your tires. But if you're not a mechanic, you likely don't have the tools, and you don't have the access to all of the information and the suppliers to do what's best. And that's what's so important.
Absolutely. And tax accountants are a whole other conversation that I
Yes.
because so many don't do it better than I do. And I'm like, if you can't do your taxes better than I can, you can't be my tax accountant.
That's great. Yes.
Absolutely. So is there still such a thing as an assumable mortgage?
So yes, however, the difference is now mortgages are assumable with qualifying. And that's the biggest difference. You have to be able to qualify to assume a mortgage. So then the question becomes, why would you look to assume a mortgage? And there may be some instances or situations where that could possibly make sense. But one of the things that people don't realize with assumable mortgages is somebody's like, well, yeah, I'll get someone to assume my mortgage, is they don't know that they need to make sure that if they do have someone assuming their mortgage and that person has qualified through the lender to assume that mortgage, that they get a letter of clearance from the lender that the lender is no longer going to hold them responsible for any future potential default on that mortgage. Because if you don't get that, even though you went and got someone to assume your mortgage, you still ultimately end up responsible for it if you don't get something that says from the lender that says, we qualified the people that are assuming your mortgage and we release you from liability, any future liability.
That is crazy. So if you don't get that letter, I'm assuming with a proper lawyer, you're off the deed. So you no longer own the house, but you're still financially responsible for the mortgage.
Yeah,
Brutal.
could be. Yes.
Oh, yeah, that would be horrific.
So,
Wow.
and that's why we don't see much for assumable. I mean, we used to have back in the early 2000s, that's when we had assumable mortgages without qualifying. And that's where there are people out there that assume mortgages that if they walked away, the person who they assumed this mortgage from 20 years ago would be on the hook for it.
Brutal.
They didn't understand it. And that's why we don't see much for assuming people wanting to assume mortgages right now, is because of when you have to qualify. And two, people understanding that if the lender's not willing to give them that clearance, why would they allow someone, if you got to qualify, so why,
you can probably qualify for a better one.
Yeah. But you know what, we may see the resurgence of assumable mortgages in 3 to 5 years when we have people that have gotten mortgages at these great rates that we're at now. And if mortgage rates are 1% to 2% higher than they are now, there might be people that really want to assume a mortgage that is at 1.99 or 1.59, and that's the route they want to try to go. So we may see it. We may see a resurgence in it as we see interest rates increase.
Cool. Are there any other kind of weird and bizarre mortgages like an assumable, or do weird ones exist? Or you're not just going in and going, hey, I need a mortgage?
Yeah, so like there's special programs like New to Canada. If you've been in Canada less than 5 years and can prove that you've paid rent for 6 months or 12 months and you have 5 or 10% down payment, and you can prove that you have a solid permanent position, you can qualify for a mortgage without having to have all the established credit that comes with for people who aren't new to Canada. Business for self. If, for example, let's say this one happens often, engineers, IT tech, they were in an employed position as an employee and their employer says, you know what, we're now going to change you to a contract position and you're going to become essentially self-employed. And if you do that into a sole proprietorship, not a corporation, there's special programs that can be considered for people that had that happen and it's less than 2 years. And they've got this new sole proprietor business that hasn't been declared for 2 years, but they've had this consistent industry. And so that would be a consideration of a special program. Special flip programs through private lending for people that want to get into flipping houses. There's some specialized programs that we have access to for things such as that. And business for self, stated income. I make all this money, but I also declare all these expenses. And so I don't look great for what I declare for income because of what I can deduct for expenses. So we have programs that are based on bank statement income from your business for stated income. Those are some of those special programs that the banks don't have access to and don't even touch in some cases.
Awesome. So this, I think, is a good time to bring back the Smith maneuver. What would be the advantage to making your mortgage tax deductible?
Well, so in Canada, there's 3 things we know. We pay high taxes. We can't necessarily rely on government pensions for our future wealth. And we don't save much to build future wealth and retirement funds for ourselves. So the Smith maneuver, when you have 20% equity in your home or you're putting 20% down on your home, you can be set up with a proper readvanceable mortgage, which means as you pay down the principal, you get a line of credit balance that becomes available to you. And without having to generate or earn more income or find a way to get more income to build wealth, you can use the principal pay down each month to invest in non-registered investments for building future wealth. And the interest on the money that you use to do that, the interest on that money is 100% tax deductible. And so it may not have huge impacts maybe in the first year or even 2 years, depending on how much you're paying down your mortgage. But it's not just about paying down the mortgage and the tax deduction. It's also about the compounding return on investment that you get from having made those investments that helps build your future wealth exponentially from day one. And that's where in the power lies in twofold. Now, as you start to convert your mortgage and you have interest deductions of maybe it's $4,000 a year, then $8,000 a year, that lowers your income by that amount. So if you're in a 40% tax bracket and you can lower your income by $4,000 a year, that's $1,000 tax return. And then you can take that $1,000 and put it against the mortgage, put it in an investment, treat yourself to something great because you've done something smart. You get to choose what you do with that tax return.
So is that, I've heard of the concept, but I don't quite understand the concept. So if I'm asking you dumb questions, that's awesome because that's the right ones. So is that basically taking your mortgage or your house as an asset and putting it into your business, or how does it become a tax deduction?
It becomes a tax. So I'll go back to the tax law first. So the tax law states that any interest paid to earn income is tax deductible. So if you take money from your resident, take equity from your residence in the form of a HELOC or through a refinance, and you put that money into a non-registered investment which has the intent to earn income, or it could be into a corporation with the intent to earn income from your corporation, because that's a non-registered investment, then the interest you pay on the money that you did that with becomes 100% tax deductible.
So it doesn't have to be in your business. So
It
if you
doesn't
did it in
have
a
to be
non-registered investment, such as
stock, bond, mutual fund, annuity, segregated fund, private equities, real estate, real estate investment trust, anything, just basically no RSPs, no TFSAs.
right. So what implication might that have if somebody dies, say? Would it be better or worse to have it in there?
Well, the implication is the same as whether you do nothing and somebody dies, right? It's a mortgage on your property. The difference being that what happens is people often use lines of credit on their home for consumable goods. They go buy a car, they go buy that new TV, they put a new kitchen in their house, which is maybe can be out, but it's a consumable. You don't get the tax deductibility from it. So if you take $50,000 from this pool of equity, now it is secured against your house, but now you've got $50,000 of investment that's also a return on investment. Should you ever feel the necessity or have the necessity to get rid of that $50,000, you have this investment that you can cash out of to then pay that down.
Right.
Which is different than consumable. You go and buy a $50,000 car, you draw it off the lot, now it's worth 40. You can't sell the car and pay off the 50.
Right. Is there any difference between just taking 50 grand off your mortgage and putting it into an investment?
It depends on how you have to have the right mortgage product to do the Smith maneuver correctly. And that's where people get into trouble or make mistakes is they don't know if they have the right mortgage product that they currently. So we take a look at that to see, do they have the right mortgage product? And then number two is they need to understand how to do it correctly, because if you don't do it correctly, that's where people end up into problems with audits. They get audited and they didn't do it correctly because they didn't have the guidance of a certified professional to help them make sure that they understood this. You can't do this. You can do this, but you can't do this. And this is how you do it. This is how you move the money. This is how you make sure that when you move the money, you've got the tax deductibility of it. And that's what's important.
Awesome. And if somebody were to say have to declare bankruptcy, does that affect their house? Because my understanding too is if somebody claims bankruptcy, that in certain cases it doesn't affect their house, or is that still the case?
Yeah, that's still the case. If you declare bankruptcy, it doesn't necessarily have to impact the house. Again, that's a unique situation to someone in and of themselves. And as to why are they declaring bankruptcy? What do they have for assets? Because the bank's going to look at what assets do you have? Well, you've got $75,000 worth of assets, and you've used $75,000 from your home to buy those assets. Well, what happens to those assets when you declare bankruptcy? Because, and so there's
an asset, or is it your house?
Yeah, there's a whole consideration the bankruptcy person's going to take, judge is going to take a look at in determining how they would set up your bankruptcy. So the goal is to not get there.
Clearly.
Not get there.
Goal is to make these assets work for you so that you have assets and a positive net worth, and hopefully a fantastically positive net worth. Awesome. Good answer. Thank you. Loving it. I think we covered all of the questions I had, except for investing in Canada. So if we have Americans or somebody not Canadian listening to the podcast, what kind of things can they do why you'd invest in Canadian real estate when you can invest in American real estate. I don't know, but what might be some of the advantages to that, and how could they go about doing that?
Well, so any foreigner investing in Canada, they require 35% down payment to invest in Canada. Now, one of the reasons why other countries and billions of dollars a year come and invest in Canada is because we have considered the most stable banking system in the world. So that's number one. Our real estate is considered to be some of the most stable in the world. When you look at what happened in the US in 2008, their banking system collapsed, housing in major cities completely collapsed, and now they've managed to make some recovery on that in most cases, in some cases not so much, and that's why people invest in Canada. Now, are there opportunities that are great in the US? Absolutely. Are there opportunities that are great in Canada? Absolutely. But that's where I'm a backstop to my investors when they bring a deal to me, and I look at, what is their plan, and is this property a good fit for their portfolio and their cash flow? If a property is going to be a negative cash flowing property, my question is going to be, well, why? Why are you wanting to buy a negative cash flowing property? Explain to me the reason why this is a good investment. And if they can sell me on why it is, then okay, well, I mean, I'm going to do what the client wants me to do, but I want to make sure also that they're realizing the implication of buying something that's, negative cash flow.
Awesome. Because I know just from the prices in Vancouver, Toronto, Calgary, it's like, I guess my assumption was that they're doing it for the purpose of increasing, of buy low, sell high. But there are other opportunities, I guess, to buy in Canada. Do we have the same invest to immigrate kind of rules and regulations that we have going to the States, or are there other reasons why somebody would want to have a negative return investment?
Yeah, typically if someone's buying something and they're willing to take a negative return on investment, it's typically because of a tax reason. They've got, they're earning a certain amount of income and they need something that's negative cash flow that's going to drop their tax from one level to another level, and that's going to save them significantly more than what they will lose on that investment. That would be but those are very rare. It's very rare instances where those happen. There are still great cash flowing opportunities in Calgary and Edmonton, more so in Alberta and Saskatchewan and maybe even Manitoba than parts of Ontario and BC, because of how prices have shot up in those areas. Again, with enough down payment, anything can cash flow is kind of the typical line. So that's why you do see foreign investors buying in Toronto and Vancouver maybe more, is because of that 35% down payment requirement. Well, for them, that can make those properties cash flow easier than trying to do it with 20% down.
Awesome. So talk to me about the real estate investment world in Alberta, particularly in Calgary, just because that's fun. What's going on and what's a good opportunity?
So the best opportunities in Calgary are within legally suited properties, for investors to be able to buy those and have the multiple cash flow sources. Because if you buy a legally suited property, or you buy a property that has an illegal suite and then legalize it, you've got two sources of income from the main floor and the basement suite, as an example, or maybe it's a garage suite. That's another possibility. And then if you've got that detached garage, well, you have the chance of maybe also not all tenants necessarily want a garage, but you have some tenants that do. So you could also generate some extra income from that garage. Or maybe you have also the ability to have space where they could park a trailer. Maybe you have tenants that have a trailer. So that could be another option for generating some additional income, is by allowing them to park their trailer on there. So there's different ways to help improve cash flows, but there's still great opportunity. But those are the suited properties are generally the best opportunity in Calgary right now for generating cash flow.
Awesome. And are the regulations such that somebody could buy a house that needs renovating that doesn't have 2 suites right now, that could have 2 suites, so that when they renovate, they build in those 2 suites and make it a positive generating asset?
Yeah, and so there's the secondary suite bylaws in Calgary have shifted a whole bunch over the past 9 years. Now, not so much since 2018. April of 2018 was kind of the last change. I was actually part of that as a public-private citizen. I was part of that process in consultation with some of those things that happened. And so right now, until December 31st of 2021, if you buy a property with an illegal suite that was built prior to April of 2018, you can legalize that suite under the fire regulations, under the fire code, which eliminates the need to have 2 furnaces or 2 heat sources in the property. So that generally costs much less expensive to legalize the suite. So in that case, you have to have your submission in to legalize the suite before December 31st, 2021. Now, if you're buying something that, like you mentioned, a renovation to add a new suite, that falls under the Alberta Building Code. And you have to look at your land use. And depending on your land use, that dictates what the process is. And so if you have an RC2 lot or something like that, then the process is quite simple and quite easy to get approval. If it's RC1 or it has a 1 in it of some kind, the process is slightly different, slightly longer, and there's some different things that have to happen for you to be able to get that permission to be able to add that secondary suite.
Awesome. So that sounds like a fantastic opportunity for real estate investors and people that are looking to get into real estate as an investment.
Yeah, and some people, first-time home buyers can use, I'm seeing this more now where first-time home buyers are buying a property with a legal suite because it's a mortgage helper, but it's also a mortgage qualifying helper. Because if it's a legal suite, we can use the income from that legal suite to help them in qualifying for their financing.
Awesome. That is brilliant.
So it increases the amount of mortgage they can qualify for compared to just their income alone.
That's awesome. Cool. So are there any questions about mortgages that I should have asked you that I haven't?
Oh, fixed versus variable. What do I do? That's one of the ones that comes up. What do I do? Fixed versus variable. Well, I can tell you that right now, variable rates are looking pretty good at prime minus 1.25%. So a net rate of 1.20% from some lenders right now. That compared to fixed rates of 1.74% is the best fixed rate right now. Most lenders are in that 1.99% range. So that variable rate is pretty favorable. You can counter off a lot of prime lending rate increases on the variable rate before you would, exceed your mortgage rate on the fixed rate. But again, it boils down to risk. What is your risk tolerance for taking that into consideration?
So give us an example of a Cinderella story, if you have one. Just somebody that was having a hard time that all of a sudden they met you and it was easy, or they were broke and they went into riches because of all the stuff that you made for them, anything at all.
Yeah, so one of the most common ones that is most satisfying to me is when someone comes to me and they go, we need to refinance to reconfigure, save on our mortgage, reconfigure our debts, do some, maybe consolidate some debts. And setting out the plan for them with the refinance and paying out the right debts first so that they lowered their payments by $1,000 a month combined with the things we did initially. And then showing them how to use that $1,000 to pay down debt accelerated within their plan, rather than taking that $1,000 and consuming it. Because they obviously could afford what they were paying because they were paying them, but boy, their cash flows were tight. And they just didn't like where that was heading. So just by rejigging it, we improved their cash flow by $1,000 a month. We used that to accelerate the pay down on the next most expensive or high interest debt, so that we could start and then just rolling it over into the next debts, and being able to continue that. You're always that whatever that initial savings one, that's what you want to use. Now, if you pay off another debt, if you decide you don't want to roll that $300 a month payment into what you're going to do to pay down the next one, okay, you want to use it to create some additional savings, that's fine. But we got to have that plan. And when you have that plan in place and people do it, and all of a sudden in 18 or 24 months, they come back and they go, we've paid off all our debt, or we've only got this much debt left. We're so glad that we did it. That's when it's
nice.
more exciting.
Consumer debt bad, investment debt good.
Yeah, exactly. And it's some of those other satisfying ones are people that come and they go, we couldn't qualify at the bank. And I talk to them and I find out their situation, and they tell me they have kids and they receive child tax benefit. And I go, oh, well, we can use your child tax benefit as part of qualifying for a mortgage with most lenders. They go,
wow.
Really? We didn't know that. We get $1,000 a month in child tax benefit. Well, that $1,000 a month in child tax benefit, that's going to help them huge. With like over $100,000 worth of mortgage qualifying.
Wow, that's awesome.
It's some significant things that can happen with just understanding a full story and situation.
Nice. So you've mentioned a couple of them, but what are some other stumbling blocks that somebody might be having right now and they're thinking, oh my God, Keith, I need you so badly right now?
So some of the roadblocks people might have, number one is their business for self and they're having trouble qualifying for a mortgage or a refinance. Mm-hmm. We need to have a conversation. There's some very specific lenders with some very specific different guidelines that can work. Or somebody that's got very minimal income, but maybe high net worth, and they're getting income. Their income is based on investment returns right now. And that's where most of their income is coming from. Well, we have, some special net worth lending programs that can be looked at to help them qualify for financing. Done a few of those of different, more recently. And some of that is because of what's happened in COVID. They had investments, they got laid off because of COVID, and now their income is from their investments, and that's what we've had to use. So those are some of the things, some of the situations people might have. Going through a divorce, and one of the spouses wants to buy out or take and clear the mortgage off from being in both names. There's specific special spousal buyout programs for that. A lot of people don't know that they can basically purchase the property from the spousal relationship, marital relationship, to themselves and still be able to do it at a high ratio mortgage of up to 95%.
Up to 95%, holy.
Yeah. And generally what they say is, we'll go up to 95% based on what percentage of equity in the property is needed to pay off debt and pay out the ex-spouse.
Wow, that is awesome. So I have loved this. Thank you so much for your time. Clearly, I've taken all your time. I know that our listeners are going to want more from you. So how do they start their journey with you?
Yeah, so they can start by emailing me, keith@enrichmortgage.ca. And I will send them the link to my calendar so we can schedule an initial discovery call to find out a little bit more about their situation and how it is that we can best help them to get them moving forward to qualifying for a mortgage. Awesome. Or exploring the Smith maneuver or whatever it might happen to be.
Fantastic. So peeps, if you're driving right now, just go to awarenessstrategies.com/blog and we'll have all of Keith's information there. Just search on Keith or mortgage broker or Smith Maneuver or whatever you remember. The show will have it in there for you. Or if you're on iTunes or otherwise, just scroll down and we'll have those in the show notes for you. Awesome. So before I let you go, I have to know, at what point in your life did you know that you were a special kind of crazy enough to become an entrepreneur?
Oh boy. You know what? I probably knew it 30 years ago. And the reason I say, and did I know it then? I didn't know it then. But when I look back on it now and I look at things that I did 30 years ago, actually, I could even probably go back and say from the time I was 9 or 10. And here's a little story about me that's a little bit crazy, but here's what happened when I was 9 or 10 and that's why I would say this. I had a paper route and I delivered papers. And so at Christmas one year, I decided that just because of how I grew up and what my parents had taught me, I decided that each person that I was a customer, I would ring their doorbell, hand them their paper and wish them a Merry Christmas. That was the sole, in my head, that's what I was doing. Well, as I did this and I started doing this on the first 5 or 10 houses, all of a sudden it was like, oh, just a second. Let me give you a little something. $2, $1, $5. All of a sudden I started getting this money. And I'm like, oh, cash. All right, well, I'm going to keep doing this. So my paper route normally took me like 45 minutes, maybe an hour in the winter to do. My parents were freaking out because I was up to almost 2 hours and I wasn't home yet. And my paper route was right close to my home, like across the street from my home. And it wasn't a very big area, but I was like almost 2 hours. They came out looking for me. Like, what is taking you so long? Oh, one lady she was baking fresh cinnamon buns. She invited me to hot chocolate and a cinnamon bun. So I went in and had a hot chocolate and a cinnamon. My parents even know these people and I knew them from and stuff. But I ended up making like $80 that year in like tips that I hadn't counted on. I told my buddy about it. He had a paper route too. He went and he only made like $30. He was so mad. And so I did that. And then I had my paper route for another 1 or 2 years after that. And I did it each year after that as well. So that's kind of where my first entrepreneur experience was there. And then, I became a basketball referee when I was 19. And when I did that, really is an entrepreneurial job. You control your schedule somewhat. You're making some money. You're doing something completely different. And you have to do specialized training to specialize in it because there's not everybody willing to do it. And so that was, those were my first kind of inklings that I was entrepreneur minded.
Those are awesome. I think that's one of the best entrepreneurial stories I've ever heard. It's like, hey, how you doing? Oh, have money, have cookies. I'm like, yeah, that worked really well. I think I'll do that again.
Yeah. My parents weren't so keen on it when they couldn't find me. They were driving around the block and they saw my sled with the bags and I was nowhere to be seen. Well, I was in the house having hot chocolate and cinnamon buns. So
that's beautiful. Awesome. Thank you, Keith. So any last words for our peeps?
You know what? I always just say this. You don't know what you don't know. So don't be afraid to ask the question. And that's what I'm here to answer questions. Even if we don't end up doing business together, if there's something I can do that can help you see something differently, that's going to make an impact on how you change and live your life going forward, that maybe makes help you create a financial life by design, then that's fantastic. I want to see people live into their future and not have it just happen to them.
Nice. I love that. Financial life by design. That's a new moniker and tagline. It's going to be used everywhere. Awesome. Well, thank you, Keith. And this is Michelle Nedlak. Thank you so much for being here with us today. If you know anyone who would make a great guest for the show, or if you have a question or topic that you'd like me to discuss, reach out to me at michelle@awarenessstrategies.com or connect with me on LinkedIn or Facebook. I'd love to hear from you. Thank you for listening to our show. I am all about being a resource center for entrepreneurs to give them the information and the support they need to make it in business. As such, I have Taking Your Business Digital Q&A every Wednesday at 2 p.m. Mountain. To register for that, go to awarenessstrategies.com/digital. That's DIGITAL. I look forward to meeting you and actually finding out how you are. So see you on the flip side.